Welcome to our session in the US macroeconomic outlook and trends. My name is Ignacio Morales, and I am the North American Air Freight Product Marketing Manager at UPS Global Freight Forwarding, and I will be your host. This session is brought to you by the Chief US Economist at IHS Markit. It is my honor to introduce our guest speaker today, Joel Prakken, a thought leader of the US economic outlook, monetary policy forecast, and fixed income markets for over 30 years of experience and expertise in as a macroeconomic modeler. Dr. Prakken has developed an unmatched structural econometric model of the US economy. He co-founded Macroeconomic Advisors, which was acquired by IHS Markit in 2017. Prior to founding Macroeconomic Advisors, Dr. Prakken held the position of a senior economist at the world headquarters of the IBM Corporation. Before that, he served with the Federal Reserve Bank of New York. He's also past president at the Gateway Association of Business Economists in St. Louis. Dr. Prakken has many publications to his credit, including papers written for the Council of Economic Advisors, the American Council of Capital Formation, and the Center of American Study of Business on topics ranging from tax reform, budget policy, monetary policy, the impact of technology on productivity. He has testified on these topics before committees in both the US House of Representatives and the Senate. Dr. Prakken has participated in meetings of the outside consultants to the Board of Governors of the Federal Reserve System. He's a past member of the panel of economic consultants to the Congressional Budget Office, and he currently is a member of the advisory committee to the Bureau of Economic Analysis. Dr. Prakken completed his undergraduate degree in economics at Princeton University and holds an MA and a PhD in economics from Washington University in St. Louis. Joel, welcome.
Thanks, Ignacio. That guy you just described, he sounds pretty interesting. I'd like to meet him sometime. Could be an interesting conversation. All right, good morning, everyone. Joel Prakken here, Chief US Economist at IHS Markit. I'm going to spend 25 minutes or so visiting with you about the US economic outlook. And I think the best way to approach the discussion this morning is to divide time into two parts. The first part is before the Russian invasion of Ukraine, and the second part is afterwards. So let me begin by reminding you what we thought we were looking at in terms of the US macroeconomic outlook before that invasion, and how events in Russia and Ukraine since that invasion are affecting our view of where the US economy is heading, and indeed what some of the impacts are around the globe. So before the invasion, our view was that economic growth in the United States would be slowing from a very strong and above sustainable pace in 2021 to a slower, reasonable, and sustainable pace in 2022, as a variety of different factors came to play in shaping the economic outlook. The first is that 2022 we saw as a year of transition from the provision of both monetary and fiscal stimulation to the removal of both monetary and fiscal policy accommodation, as the funding for emergency COVID relief that was passed in 2020 and 2021 gradually waned, and as the Federal Reserve contemplated and then soon begin raising interest rates and allowing their balance sheet to shrink. Okay. In addition, the economy is approaching its capacity constraints. The unemployment rate is below 4%, which is well below the historical average and even below what some economists would consider being full employment. And when the economy is close to its capacity constraints in that manner, its growth going forward becomes more and more determined by constraints from the supply side of the economy rather than the state of aggregate demand. In terms of inflation, which has been quite high recently, we were expecting that the gradual resolution of supply chain disruptions would allow inflation to moderate from significantly above the Federal Reserve's long-term inflation objective of 2% back down towards that 2% objective, probably declining sequentially throughout the year and arriving in the vicinity of 2% sometime in 2023. Okay, in addition, in the background, supporting continued expansion was our sense that we were transitioning from a COVID pandemic to a COVID endemic, okay, in which the policy going forward would be to accept that we would be living in the presence of the virus in our population for the foreseeable future, but through a combination of widespread vaccinations, new therapeutic techniques for dealing with disease once one became infected, and reduced hospital utilization rates, that the transition from pandemic to endemic would allow a gradual recovery in consumer spending on those services that were particularly at risk to the virus, and also would allow a gradual return to the workforce of those people who, for a variety of reasons related to the pandemic, have temporarily exited the workforce. So there was a fairly, I'd say, sanguine and optimistic view of where the economy was heading. Yes, there were some speed bumps in the way in terms of supply chain disruptions, but even those seem to be improving. We've been keeping close track of things like the supply of semiconductors to the vehicle industry. That situation is improving. The backup of container cargo ships at the LA Long Beach ports, that's been gradually improving. So we were feeling pretty optimistic about the US economic outlook. Now, how has all of that changed since the Russian invasion of Ukraine? The only thing that I can say for sure at this point is that it's a negative for the US economy's real growth rate, and it also means higher inflation. This is also true not just here in the United States, but around the world. But what I can't tell you is the precise magnitudes of these impacts, because the situation on the ground is so fluid, and both the economic and geopolitical outcomes of this conflict are so uncertain at this point that the best we can do is think about a range of possible outcomes. What I think would be useful for you to understand, though, are the channels through which we see this affecting the US economy and also the global economy. So let me outline those for you and then talk a little bit about the potential magnitudes. Primarily, this is going to be a shock to the prices of certain commodities, in particular energy commodities and agricultural commodities. And since both food and energy are important parts of budgets all around the world, a shock to these commodity prices undermines real incomes, and that in turn works to slow consumer spending, which in turn, because it's 2/3 of total GDP in most countries, means slower economic growth. And slower economic growth could then have knock-on effects in encouraging businesses to trim back their plans for capital appropriations. Now, the responses around the world to these commodity price shocks vary by region because circumstances in different parts of the world are quite different in some places than in others. In the United States, for example, an increase in energy prices and the impact that it has on the US economy is far more nuanced than it used to be, say in the late 1970s and early 1980s when the OPEC cartel first formed and over a period of 7 or 8 years caused an 8-fold increase in oil prices. In particular, with the advent of horizontal drilling and fracking in the shale oil industry, the US actually now produces almost as much crude oil as it consumes and is beginning to export a fair amount of both petroleum and refined products. What this means is that when the price of oil globally goes up, yes, it's true that consumers pay more for gasoline, and that's a negative for consumer spending in the economy, but it's also true that producers see their revenues rise, and since the producers of energy are owned by other consumers, the owners of those businesses benefit. So there occurs in the United States a transfer of resources from consumers to producers of energy. Now, we do think that the negative effects on the consumers of energy outweighs the positive effect on the producers of energy, at least in the near term. So overall, this is a negative for the United States. But this circumstance is far different than it was in 1980, when the US consumed far more oil than it produced, so that a price increase amounted to a tax that global producers were imposing on the United States. So that is one way in which events over the last 3 or 4 decades have attenuated the potential downside impact on the US from a rise in energy prices. Okay, another way in which we are insulated from these shocks in a way that other parts of the world aren't is that we have a very plentiful domestic supply of natural gas. Okay, and unlike oil, natural gas is not traded in a global commodity market with a single price. Our market is detached from markets elsewhere around the world. And given our ample supply, there has been barely any increase in the price of natural gas within the United States. Contrast that to the circumstances in Europe, which is highly dependent on natural gas piped in from Russia, where natural gas prices are soaring. So in Europe, for example, not only are they facing higher oil prices and gasoline prices, they are also facing dramatically higher prices for natural gas. Whereas here in the United States, we're facing higher gasoline prices, but our oil producers have seen their incomes rise, and there's been very little change in natural gas prices. So not surprisingly then, the United States will survive these shocks better and in better shape than we'll say the European economies or the United Kingdom. Now, another channel that of considerable concern has to do with agricultural prices. You already know that Russia is one of the major suppliers of crude oil to global markets, but Russia and Ukraine together are major suppliers of wheat and corn to global commodity markets. And our agricultural group here at IHS Markit is worried that this conflict will interfere with the harvesting of the winter wheat crop shortly, and may also interfere with the planting of the spring crops, which would be harvested later in the year. Okay, in which case, the recent increase in global agricultural commodity prices could persist all the way through the next planting and harvest cycle. So not only are we looking at an increase in energy costs here in the United States, we're looking at an increase in food prices as well, again, with the effect of undermining personal incomes and undermining consumer spending. Now, looking a little further out here in the United States, if oil prices remain as elevated as they are today for any protracted period, you could expect the domestic energy industry to increase its investments in the drilling of oil wells. And shortly thereafter, you could expect to see an increase in the production of US energy and crude oil, particularly shale oil, which would help offset some of the shortages in crude oil that are emanating out of the Soviet Union, and also would also represent an increase in capital spending here in the United States that could partially offset any drag on the economy from a reduction in consumer spending. A lot of people are asking us, what are the implications of all of this for monetary policy and interest rates? You'll recall that in my discussion of events before the invasion, we were expecting the Federal Reserve to begin raising its policy rate in March and continue doing so through this year and into next year in its effort to contain inflation close to its long-run objective of 2%. Higher energy and food prices obviously raise inflation, and by itself would encourage the Fed to stick to the plan to remove monetary accommodation. On the other hand, if as a consequence of events out of Russia, we see a protracted slowdown in economic growth around the world and in the United States, all else equal, that would encourage the Fed to either delay or perhaps even move in the opposite direction in terms of monetary policy. Our view right now is that the increase in inflation that is associated with these price shocks is here and now and seen. The potential headwind for real economic growth is uncertain at this point and not yet visible. And the Fed is quite concerned about the potential for longer run inflation expectations to become untethered and begin moving up. So for now, we are of the view that the Fed will go ahead and start removing monetary accommodation as early as March. And the Fed chair in recent congressional testimony has said as much and will likely keep doing so for the remainder of this year and into next year. So we can think about interest rates gradually moving up as the year goes on. It is interesting to think about the longer term ramifications of what's going on in the Ukraine. I think, for example, we must contemplate the fact that federal budget priorities are likely to shift away from the non-defense and social agenda championed by President Biden towards the defense function as we reassess our concerns about the threat that the Soviet Union poses to the NATO alliance, and in particular the countries in Eastern Europe that are the firewall against Russian aggression. So a change in fiscal priorities down the road is something to contemplate. It's also the case that we're likely to see fairly dramatic transformations, particularly in Europe, in the supply and demand for energy. In a really stunning turn of events, Germany, who has been cultivating their relationship with the Soviet Union for the better part of 3 decades and has become quite reliant on energy supplied out of the Soviet Union, has on a dime turned and said they will now try to wean themselves from dependence on Soviet energy over the next 15 to 20 years. And my sense is that other countries with that same vulnerability, while not having announced such an explicit time frame, will be thinking about the same thing. In addition, it seems to me that this could only hasten the eventual conversion away from fossil fuels towards renewables, as no one wants to be caught in the future in the circumstances that we're facing now. All right, let's turn then to some numbers. Our forecast for growth of real GDP in the United States before the invasion was 3.7%, and that's measured as a year average for 2022 over the year average for 2021. Okay. Subsequent to the invasion, given the increase in energy prices and food prices, we've revised that down by 0.4 of a percentage point, from 3.7 to 3.3%. Our forecast for inflation, headline inflation, which includes the prices of food and energy, has been revised up quite dramatically, almost by 2 full percentage points, close to 6% for this year, before then declining gradually next year. As you might imagine, the major source of the downward revision to GDP growth this year is in consumer spending, where real disposable incomes are significantly undermined by the increases in gasoline and food prices. But there are knock-on effects into other sectors of the economy as growth slows and demand slows in certain sectors, and companies in those sectors respond by scaling back a bit on their capital spending plans. We continue to think that the Federal Reserve will begin raising interest rates in March. I would look for 5 rate increases of 25 basis points each by the end of the year. Now, what are some of the risks around this forecast? We have an energy team here at IHS Markit that is thinking carefully about the various geopolitical scenarios and what they would imply for the price of oil. A reasonable baseline pass, they feel, is that the price of Brent crude, which is currently trading the range of 120 or so, probably will move up from that point as Russian oil exports are removed from the market. And we could see briefly, as a baseline case, oil prices touching 150 before declining in the second half of the year. But there are other cases that are more severe. Okay, in particular, a scenario in which geopolitical events essentially remove the entire 7.5 million barrels of Russian production from the potential export market, pushes the price of Brent crude up over $200 a barrel for most of this year. Okay, that would be a sort of scenario that would tip the U.S. economy into recession and would imply a fairly sharp contraction in Europe. Those kinds of price increases are just too much to sustain without eroding real activity, real economic activity around the world. I think, Ignacio, why don't I stop here and let's see if we have any questions in the queue.
Perfect, Joel. Checking in, we have some comments, but no questions thus far. So we can give folks maybe a few minutes and.
So while we can wait, I'll elaborate on a few points that are top of mind for me. One has to do with fiscal posture and the withdrawal of fiscal stimulus from the U.S. economy as we head into 2022. In 2020 and 2021, Congress enacted 6 different COVID relief measures, which gave unprecedented support to personal incomes, to corporate and business incomes, and to state and local governments. And that support is now dwindling very quickly. And by the middle of this year, will have fallen essentially all the way down to zero. A lot of people have asked me or commented to me, yes, we understand that, but we've also passed what has been billed as the largest infrastructure spending bill in a generation. Won't that provide a new stimulus that could replace or supplant the waning stimulus from the emergency COVID relief measures? And the answer to that question is yes, we have in fact passed that infrastructure spending bill. It's not nearly as large as was advertised in the press because much of the spending that was advertised in the press was already included in our baselines. So there was really only about $500 billion of new spending in that bill. It would be spread out over quite a long period of time because it does take time to design projects, do the environmental impact studies that are necessary before breaking ground, and then the projects themselves, once underway, can take a long time to complete. So thinking the spend out on the infrastructure bill is 8 or 10 years. $500 billion of new spending spread over 10 years is $50 billion per year on average over a decade. Contrast $50 billion a year to the COVID relief, which at one point was $3 trillion at an annualized rate in the middle part of last year. So yes, the infrastructure bill is coming. It will be a stimulus to aggregate demand. It will also improve productive capacity on the supply side of the economy by addressing longstanding needs in terms of our transportation system, our electrical grid, and our communication grid. But it's still the case that even with the passage of the infrastructure bill, we're looking at a withdrawal of total fiscal stimulus as we move from 2021 into 2022 and 2023.
Thank you, Joel. I think we got a question for, or time for one question here. And the question would be, if oil hits $200 a barrel and we go into a recession, what's your best estimate that how long it would take to get through that?
I think it would be brief. A price that high will destroy demand quickly. In addition, it will prompt non-Russian producers to increase production in an attempt to grab market share. And also, it's not in the best interest of the non-Russian producers to allow the world to plunge into a global recession. Okay, and then finally, here in the United States, a price that high, if sustained for any amount of time, will elicit an increase in domestic production. So I think the best way to think about that sort of scenario is prices spike to extremely high levels, okay, linger there for a while, months say, but then fall very, very sharply as global growth slows and as non-Russian production rises, so that both the demand curve is shifting down and the supply curve is shifting up. And given how steep both the supply and demand curves are, it doesn't take much of a combined shift in those curves to give you quite a sharp drop in price. I think here in the United States, we would be looking at a modest contraction of GDP in the middle of the year, and probably returning to positive growth at the end of the year. It would be much more severe in Europe, much more severe. I think you would be contemplating there. We wouldn't characterize that as a contraction. I think we would characterize what would happen in Europe probably as a recession. So it would occur in this year, and growth would resume in 2023 on a yearly average basis.
Great, Joel. Well, I want to thank you very much, Joel, for all those insights. And you certainly have a tough job, as you know, this is a very fluid, dynamic situation that we're in, and I'm sure things will change in the weeks to come. But we really want to thank you for all the explanations and your comments. I want to thank our audience. Thank you for attending this session and being active on the chat as well in some of your questions. Remember that our scheduled program now it's over, but feel free to walk around or roam around our platform. We have some booths that will be open with subject matter experts that you can ask questions to. We are having a networking event from 2 to 3 p.m. Where we'll be paired randomly with someone that you can talk to and meet for about a 3-minute period. So please join us for that. And I want to remind you that at 2:45, we will have our raffle in the main stage. So please be part of that. And I want to thank you again for attending, and enjoy the rest of your day.